Well, good morning. This is Michael Douville. It is February 20th, 2020. This is a recap from our live webinar on Tuesday. We generate a lot of calls. As you recall, I've been going over strategies that are available in my book, How to Create a Real Estate Money Machine. We talked about the strategy of PPOs, which are private placement offerings. Now, this can be a very good place for a portion of your investable dollars. Now, what's really nice about a PPO is that they pay a nice cash flow. Basically, you're being the bank because this is a way a general partner can raise funds and finance his project, and he's giving back through your cash flow, so you're earning a return on it. Typically, it's maybe 5 or 6% in today's marketplace, which is pretty good return considering that we're in a LIRP or a NIRP environment. LIRP here in the United States being a low interest rate policy, and those poor people in Europe talking about a negative interest rate policy where they actually get nothing on their bonds, nothing on their interest rates. So it's very hard to find a cash flow because you can get 5 or 6% on a cash flow, which is generally paid quarterly. It can be paid monthly, it can be paid semi-annually, it can be paid annually. Nothing says it. It'll always be disclosed in the disclosure statements. You're going to see when you have lots of cash flow that you're going to be getting a lot of partners that would be pension funds and insurance companies, and they're doing this because they have a burn rate of 4 to 5%, because now we've got baby boomers that are actually depleting their funds because we're taking money out of the funds instead of putting them into the funds. And that burn rate is between 4 or 5%. This way is a good way for pension funds and insurance companies to replenish their cash flow and keep the fund very solvent. Also, you're going to need to be a qualified investor. Now, a qualified investor typically means that you have $1 million in assets outside of your personal residence. Now, this just typically means that you're a fairly astute investor. You've been able to accumulate a fairly good holdings, and that you're able to make a decision if this is suitable for you and if it's a good business move. Now, sometimes you get an exemption if you are called an experienced investor, someone who's done lots of business in that particular asset class, knows the business very, very well. And as an example, if we do a lot of apartment PPOs where we're getting multifamily, you might have someone that was involved in the construction and the development and the filling and the management. These people would be fairly experienced, and oftentimes they can get a waiver on a qualified investor because they're experienced. The idea is that we're getting someone who is fairly astute and knowledgeable that's investing in these properties because they are completely passive. Now, there's a difference between being a PPO and a REIT. A PPO has segments as units that they're selling. A REIT sells stocks. Now, if a REIT needs more money, you just add many, many more shares of stocks. And shares of stocks, you can buy a share for $1. You can buy them for $10, $20, $100. Typically, in a PPO, they're selling a unit. So maybe if you're looking to raise $5 million and they're $100,000 a unit, you're going to need 50 investors. But the units are all $100,000. Now, once you put that money up, typically it's locked up for the length of the project, which again is designated in the disclosure. But they might be 3 years, might be 5 years, might be 10 years, but you're a completely passive investor. Sometimes they're fairly illiquid, so it's difficult for you to get your money out. If you needed your money, maybe an emergency came up and you needed that money, well, there's not a secondary market to sell this on. You're probably selling it to either one of the other partners or to the general, and oftentimes at a discount. So they're fairly illiquid. That's why you need to be an astute or an experienced investor so that you understand your risks. This is one of the risks that you have. That's why we say it's good for a portion of your investable dollars. We wouldn't want you to put all your money in. And then, of course, if we use the example of building a apartment complex from the very beginning, you go from development to construction to filling the units up, and maybe that's a 3-year time frame. and then you're going to sell the units. So you would have a 3-year time frame. So there would be a profit involved, and typically as a partner in the private placement money, you would be entitled to 30 or 40% of the profits. So not only would you be getting a cash flow of 5, 6, 7%, but you'd also get a portion of the profits. So it can be fairly lucrative. It is illiquid, but we just need to be careful what you're doing if you really look at it. You know, pension funds love these things for 10 and 20 years because they get this long-term growth going on their cash flow, so that's very, very good. Now, we say a portion of it because here again in our portfolios, you own them, you control them. We typically use a single-family home, and of course, we're in that entry-level marketplace where there's lots and lots of buyers, and there's lots of people looking for these. It's easy to rent, but you have control over them, so if you need to sell them, you can sell these properties, unlike the PPO. Now, this is an investment idea for you. There's many different strategies that we have. If this works for you, we're more than happy to sit down and talk with you. You should always talk to your partner, talk to your spouse, talk to your financial advisors, your accountants. Make sure that this is suitable for you and something that you want to be involved in. If you'd like to run it past us, we're always interested in this. We're more than happy to brainstorm with you and go over what's good for you and what's not good for you, if it fits in your portfolio or not. We do that a lot. We talk to a lot of your advisors. So if you need me, you can get hold of me at michael@michaeldouville.com. You can call me at my corporate office at area code 602-942-4200. And my very, very best to you. Bye-bye now.